Welcome back. We are back with Brianne Gardner from Velocity Investment Partners. She wants to talk now about the strength or lack of strength in the consumer. We've talked about recession. Are we seeing cracks in the ability of the consumer? So important to the U.S. economy and our economy here in Canada as well.
Yeah, exactly. The consumer drives GDP growth, right, and spending. So if we are out there spending, then that's when we continue to see GDP and, not head into a recession. So for us, 70% of GDP growth is in the U.S. is driven by consumer spending, 55% in Canada. But we are starting to see those cracks, as you mentioned, from the consumers. So we see that through, increased bankruptcy filings. We're seeing U.S. credit card debt surpass $1 trillion for the first time ever. So people are spending on credit, and those surplus of savings that people had built up from the pandemic, and they've spent all of those. Mm-hmm. So, I saw there was this stat that came out, I believe, last month, and Canadians have, less than $150 now per month to live off of once they've paid all of their bills and spending. So, I think Canada is a little bit more of a dire situation than the U.S., especially with our variable mortgages and the amount of debt that Canadians are carrying right now. Right.
Is there going to be more pressure on the consumers? A lot of people in your world predict that when mortgage renewals start happening, many consumers are going to have no choice but to put more towards their mortgage and therefore less on any type of discretionary item.
Yeah, exactly. I think we are starting to see even, pull back in some discretionary spending. If you think of hotel costs, and even with the spike in oil, travel costs and traveling for Canadians have started to come down as well. And even bank lending, we're seeing definitely tightening on lending, and requalifying at these high rates is harder for Canadians to do that. And also high borrowing costs, right, with where interest rates are. So I think that all impacts the consumer at the end of the day. So if they don't have as much disposable income, they're tightening the belt on spending. That's reducing GDP, which will ultimately put us, into a recession. So for us, again, that's why we are a little bit more conservative, a little bit more defensive right now, and focusing on profitable businesses that can weather that.
And I think we've got to look at credit card debt surpassing $1 trillion recently, credit card debt reaching record high. This comes from, as you can see, the Federal Reserve Bank of New York. This would obviously be U.S. credit card debt surpassing for the first time $1 trillion U.S. How concerning is that, Brianne?
Yeah, it's definitely concerning is that, people are out using these credit cards, and with interest rates where they are, some credit cards are 18 to 22, 23%. So to repay that credit, people are living off of credit now. They're tapping into any savings that they do have left, and, that's what they're living on. So for us, that's not in a great position as a consumer that we don't have this pent-up savings in our bank accounts anymore. And also with the U.S., something else that we are watching is these student loan repayments that are kicking in too. So that will impact the U.S. economy too. So, there's definitely a lot of moving pieces going on that is showing to us, the consumer is slowing. Labor market is starting to show cracks as well. So for us, that all signals a little bit, weaker times ahead.
So let's revisit your portfolio choices on behalf of clients then. In this context, you would avoid consumer discretionary stocks.
Yeah, I think we're underweight the sector for sure. Right. And to us, again, overweight healthcare, utilities, and consumer staples at this time. Tactically, we've overweighted energy from a tactical play, not a long-term play, but we do see still a little bit more upside in the energy sector. And again, I think it is important to be active, because what heads into a recession and what comes out of a recession, right? Tech does do very well coming out. Small caps do very well. So when we start to see that role, those lead again, we know we'll have to pivot from more defensive to more growth focused and shift that asset allocation a little bit.
What about banks, U.S. banks, Canadian banks? How do you look at them in an environment where the consumer is getting weaker?
Yeah, everything that happened with the banking crisis this year, people were freaking out about the banks, and pretty much most of them, if not all of them, have recovered back to where they were. So for us, we actually took advantage of that volatility and were able to pick up some U.S. banks at a discount for us. I'd say we're, again, neutral neutral kind of on that sector, both Canadian and U.S. banks, but do have exposure to both of them. And like, BlackRock, TD, Royal, a lot of the kind of the big, higher quality names, again, that do have strong balance sheet, do have good leadership and management in place, and have those loan loss provisions that we know, are positioned, their books and their balance sheet to be able to come through this.
You said you're overweight energy on a tactical basis, so that doesn't sound like a long-term hold. What would it take you to sell some energy stocks on behalf of clients? Yeah,
I think we've seen, we saw a little bit of a breakout in energy. So once we see that, that gives us a little bit of a trigger point to add to our exposure to the sector and just kind of ride it out a little bit. We're not heavily overweight, but just slightly overweight, about 2% compared to the benchmark. And we wanted to take advantage of that. So for us, we are happy with that.